It's all over the news. You know it, I know it. And we all know it. Widespread anxiety about the health of the American economy has resulted from the Federal Reserve's decision to raise interest rates to battle inflation, a battle that many analysts say is already completely lost. And one legendary investor predicts how the next rounds of the inflation war will play out. American equities are in a super bubble of speculation, and investors risk losing a lot of money if they don't move quickly, according to Jeremy Grantham, a well-known and experienced fund manager. In light of Grantham's prediction, investors are less bullish on the stock market and more concerned about the Federal Reserve's attempts to curb inflation. According to Grantham and his colleagues, developing economies have superior value and promise over the long run. There is no shortage of apocalyptic predictions, but when the evidence of an impending disaster becomes overwhelming, it is easier to accept them. It's hardly surprising that a warning from a well-respected senior investment manager about a super bubble is getting a lot of attention, given that the stock market has seen one of its largest losses in over a decade and looks to be beginning another leg down following a rebound earlier this summer. Investors' insatiable appetite for risk has driven stock values to extremes seen just a handful of times in the previous century, according to Jeremy Grantham, the GMO. His most recent work, Entering the Superbubble's Final Act, was published on August 31st. In it, he drew parallels between the years leading up to the Great Depression in 1929 and the unexpected collapse of the dot-com industry in 2000. He also discusses the late 1980s obsession in Japan and the demise of the Nifty 50 rally in the early 1970s. The Federal Reserve and other central banks' very cheap monetary policies helped create the stock market bubble. The result was a precipitous drop in interest rates, which flooded financial markets with cheap money and fueled speculation for the better part of a decade. According to Grantham's findings, the overvaluation generated by such excesses would lead to bubbles erupting when they coincided with deteriorating economic and financial circumstances. If it hasn't already, he expects it to happen shortly. According to his findings, U.S. stocks remain overpriced, and inflationary pressures, such as we've seen this year, have always harmed price-earnings multiples, although at a more muted rate. Unfortunately, the fundamentals have also begun to deteriorate significantly. The Chinese health crisis, the conflict in Europe, the food and energy shortages, the record fiscal tightness, and other factors have all contributed to a situation that is much more dire than anyone could have imagined in January. While every economic cycle is unique, past experience demonstrates that conditions may and often do deteriorate. He said the stock market will plummet by half but didn't say when. Bloomberg News, the Financial Times, the New York Post, Fortune, Market Watch, CNBC, and many others reported on Grantham's comments. Not a single element about the situation suggested that anything horrible was about to happen. Instead, there was much on the one hand, on the other, but not as much disinterest as would have been predicted while the market was booming. If Grantham says the market's bad performance this year is only the beginning of a catastrophic plunge, investors tend to take him seriously because of his history of success. Although he has indicated he thinks the bubble we're in is ready to burst, he is neither a doomsday bear nor an irrational golden bull. He had previously warned about the reckless speculation on Wall Street, but now he admitted that the bubble that had begun to form undoubtedly still had the capacity to develop. Some doomsayers prey on the insecurity and avarice of their audience by exploiting their concern about the impending end of the world. People often have good intentions and are forthright. Grantham is a prime example of the latter group, and he may have good cause to hold his opinion. With inflation taken into consideration and current share prices compared to 10-year average profits, the Shiller price-earnings ratio shows that the S&P 500 index is still significantly overpriced. Even if the index has dropped by almost 20%, this is still true. Early in September, the ratio hit 29.9, not far off from its level just before the 1929 market crash. Except for the dot-com bubble and the bull run that is ending now, it had not been this high since the 1870s. Despite the Federal Reserve's efforts to manage inflation by increasing interest rates, forecasts for economic growth and company profitability continue to decrease. Even though Morgan Stanley market analyst Mike Wilson has been remarkably accurate so far this year, He has just reduced his 2023 profits per share forecast for the S&P 500 by 10%. Insiders on Wall Street are increasingly concerned that the market has hit a sour spot, the opposite of a sweet spot. Investors' return to selling shows broad concern about the state of the economy and financial markets. They seem to have accepted the idea that the Fed would raise interest rates regardless of economic growth or stock market performance. There is no hint of losing ground despite the gloomy forecasts. They haven't, for example, started selling everything without any consideration. Such pessimism is typical just before a bottom in the market that should hold. According to a client letter from J.P. Morgan, the most recent sell-off was remarkably calm. In the past, relatives would start calling to advise you which assets to sell, but now you get to decide for yourself. Grantham, unlike many of his peers, cares more about the long-term results of his investments than he does about the results of the current quarter or trading session. Inflation-adjusted projections for the next 7 years are derived from the present price level, acceptable assumptions about economic and financial circumstances, and the understanding that markets always revert to long-term growth tendencies. Whether you have a very long time horizon, it doesn't matter if a pricey asset drops to a decent price or becomes too cheap, or if it returns to earth right now, soon, or for a while. The most up-to-date prediction, made at the end of July, predicts that major U.S. company stocks will underperform inflation by 2.2% annually. When accounting for inflation, they predict that certain assets, such as various kinds of bonds, would perform even worse while others, such as offshore shares, would show very minor increases. They are often upbeat because of the large gains they anticipate making in emerging markets. Although most strategy is likely to raise eyebrows on Wall Street, it represents the greatest long-term bet for the average saver. U.S. stocks don't seem like a smart bet, even if they aren't in a super bubble or a typical bubble. There are safer and higher-yielding markets elsewhere. It makes sense, given the present atmosphere, to reinvest some gains from U.S. equities in developing markets or other low-priced assets. You shouldn't disregard Grantham's counsel just because you don't believe he's a prophet. We fear that a lengthy economic slowdown is possible due to the Fed's quick rate hikes. The possibilities of continued economic growth without a recession are slim. As investors, we should prepare for the worst and cross our fingers that nothing bad happens. These next suggestions could get the job done. Maintaining a larger cash balance in one's investing account is prudent. Lessen your exposure to stock market risk, especially in rising beta markets. Bond allocations often react to quantitative tightening by increasing the average maturity of the bond portfolio. You should lower your exposure to commodities and inflation bets as economic growth slows. You'll be able to ride out any economic storm because of your preparations. If you've prepared to keep your assets secure throughout the storm, getting back to normal after it's over will be much simpler. However, if the Federal Reserve is successful in averting a recession or restoring monetary accommodation, it will be simple to reallocate funds to the riskier equity market. Putting money aside is difficult when the economy is in a downturn. You may take precautions to make sure you're ready for the increased volatility. Keep more cash on hand than you think you'll need to cover unexpected expenses. That way, you won't feel forced to sell during a downturn. Your investment horizon should be between 5 and 7 years in order to mitigate the negative effects of adding distressed firms to your portfolio. Do not let your interest in investing consume you. Taking advantage of tax loss harvesting by selling stocks at a loss might help produce your taxable capital gains. You should stick with your investing plan regardless of the market. Don't take the media's guesses about when the market will bottom as gospel. If my analysis is true, the economic slump might be much more severe than anticipated, resulting in much lower prices. And if you prepare beforehand for the next big recession, then you can make a lot of money out of it. If you love this video, subscribe, leave a like, and watch this one too.